of January 12th. Anybody have any comments on the minutes? Any changes, alterations, deletions? And if not, is there a motion to accept them?
I move we accept them.
Is there a
I'll second the
second?
motion.
All in favor?
Aye.
Aye.
Opposed? Passes unanimous. Is there any public comment? No public comment. If not, then we're going to move to approve the pension application. Jerry, we got you there?
Yes, I am here. Can everyone hear me?
Yes.
Yes, we can.
Very good. Okay, this is the resubmission of Reynon Flores application for retirement. He is a plant operator, or former plant operator, I should say, with the Department of Public Works. His pension is a regular pension. He elected the standard option. His monthly benefit would be $3,567.43, annualized to $42,809.16. And he did, at the request of the pension board, correct his beneficiary designation, and I have read it, and I'm comfortable with what he has done.
That's excellent. I appreciate you doing that.
That was good. Looks like it's in
Yes.
order. I move we approve it.
Excellent. Is there a second to that?
I'll second that.
All in favor?
Aye.
Opposed? No. Excellent. Thank you very much. You did an excellent job, Jerry. Appreciate it.
You're very welcome. My pleasure.
Okay, great. Blackrock, Britt, do you want to introduce them?
Happy to, Frank. So we have Sean, Jamie, and Henry from Blackrock, who are going to do a portfolio review of the systematic alpha tilts emerging market strategy that Norwalk utilizes. Just a reminder, I think Norwalk hired Blackrock for this particular emerging market strategy back in 2019. So it's coming up on 3 years later this year. It's a quantitative approach. So there's a number of factors that go into the modeling, as you might remember from the presentation during the finals. So with that, happy to answer any questions, or I'll turn it over to Sean and the Blackrock team.
Okay, one thing, Sean, I just want you to know that we have a lot of faith in the people that work for you. So as someone says here, we want to talk about performance and fees. So if you can move ahead with that, that would be excellent. Thank you.
Thanks, Frank. I forgot to mention that.
Yeah, you just, you forgot.
No, absolutely. And thanks for the color, Frank and Britt, and for the time to the entire board. I will just do quick introductions. I know, do we have 30 minutes? Is that correct, Britt? Okay. So we will keep it to 30 minutes, and I trust that you guys all have the deck in front of you. I guess we prefer that versus sharing our screen, if that's okay. Okay. So it's myself. Sorry, I'm Sean Patterson. I work on our consultant relations team. I cover all the great people at Callan and work with Britt closely, on the Norwalk account, as well as several other of our mutual clients. We have Jamie Gray, who is a managing director, and she works on our pensions team based in New York. She covers the city of Norwalk, as well as Henry Shen, who is a senior investment strategist within our systematic active equity platform, and he will talk through an update on the team, platform, and then get into the portfolio. Happy to cover, again, any areas at the outset. If there's any things you'd like us to weave into the conversation, please do let us know. But if not, I will hand the mic over to Henry.
Hey, thank you everyone for your time today. I will start by going to page 4, which goes over the platform and business update for the investment team, the systematic active equity team. We closed the year with $162 billion US dollars of assets under management. Majority of these strategies are what we call benchmark-driven, long-only active strategy that seeks to exceed the return of a particular benchmark or particular index based on the risk budget given for a given year or over a given cycle. And so you can see here of the 162 billion, 149 billion is what we call in the alpha tilts range. This particular strategy, the emerging market alpha tilt strategy that your organization is invested in, is also part of this construct, specifically within emerging markets. As of December end 2021, we run a roughly $21 billion of emerging market alpha tilt strategy. The entirety of our emerging market platform under SAE is roughly $24 billion. That represents a flat change year over year. So all is to say, from an emerging market perspective, it's been a stable year of and a stable platform from a business standpoint. On a broader platform for SAE, this was a successful commercial year where we had net positive flows driven by sustainability and US large cap and small cap related strategies. I'm heeding Frank's note, so I'm skipping the next page or next couple pages around platform and organization and headcount. I think, long story short, no changes in any of the people managing your particular portfolio, particular product. It's also a stable team, actually net growth in terms of headcount over the year. Let me spend a couple minutes reviewing what the strategy is about. So if we can come over to page 9 with me. This is an active strategy and this is a quantitative strategy. What that means is we drive our excess returns by modeling and create a plethora of different signals. These signals are specific factors designed to beat the market under these 3 dimension or these 3 categories. You can see on the chart on 9 here, there's fundamental, sentiment, and macro thematics. Fundamental obviously is trying to find the underlying drivers from a company to company specific perspective, whether it's a company that has improving persistent profits, rising earning expectations, or are priced in an attractive valuation. We couple that with shorter term measurements, and these we'll call sentiment. And these are really understanding the supply demand dynamics from a trading perspective, understanding what are the mass analysts across the Wall Street community, what are they influencing their clients in terms of what they're saying or what they're rating from a recommendation or earnings revisions perspective. In addition, we're also looking at across the emerging market cross-section, different flows. So different mutual funds, different hedge funds across different markets. What are they buying? What are they selling? What's the intentionality of their positioning? Lastly, with the rise of, and this is probably a bit new, rise of retail trading, that's been increasingly prevalent in terms of retail participation relative to overall market trading volume, especially, I mean, certainly in the US, but especially in emerging markets, in select markets like Taiwan, Korea, and Hong Kong. We've also increased a number of measures that try to seek and understand how retail investors intend to trade through scraping of online investment blog sites and looking at what are people discussing on these online blog sites about stock and investing. Couple that up, these are fundamental and sentiment, and what's almost equally important is non-fundamental drivers from macro thematic perspective. So understanding from a country to country dynamic, what are the relative attractive entry point between country A and country B in an emerging market space, understanding how policies, whether it's monetary and fiscal policy, affect the underlying economies and that kind of attractive dynamic between different countries. There are over 24 countries in the emerging markets. We do invest in almost all of these countries, so understanding that dynamic is important. We also want to understand the industry dynamic within the different emerging market countries. And that's certainly very important. And we'll point out a little bit, for example, 2021 was a year that IT and tech sector was very strong, but it's actually quite dispersed in terms of where that information technology returns are coming from. If you look at China, China's IT performance were abysmal, mostly driven by policy tightening regulatory actions. But if you look at IT in Taiwan and Korea, they were very strong. So trying to understand the dynamics along those dimensions help us to time the effects better, in addition to the stock selection drivers. On page 10 here. Yeah, of course.
Question. Monitoring the online blog sites. I mean, for retail, are you following the retail? Is that what that's trying to do?
So depending on the market, we will have different trading strategies. By and large, we do trade against retail. So we look at abnormal volume driven by retail trading. And usually that will mean there will be a reversal effect that would take place in certain markets. But if we find, for example, in a stock that is 90% driven by retail trading activity and the underlying sentiment of all these retail participants are overwhelmingly positive, then we would trade alongside those retail participants. And the way it works is we would use our technology to scrape and assess every single investment blog post that a retail participant would have made on these websites, and we would extract the sentiment out of those posts. So let's say for TSMC, which is a Taiwanese semiconductor company, they may have 1,000 posts over this past week talking about this particular stock, and out of 1,000, the aggregate average score is very positive in sentiment, and then that will tend to drive the signals positioning to be positive and overweight in that stock.
Momentum driven.
It is a little bit momentum, but it's specifically short-term momentum.
Are those local investors, local markets, or are they U.S. investors that you're monitoring?
They tend to be local investors in local markets. They tend to drive the predominant trading volume in those markets: Korea, Taiwan, Hong Kong.
Okay.
Okay, for page 10 here is just a schema based on the 3 insight categories I just mentioned. I'm not going to go into specific details, but this gives you a view on the various subcategories within these 3 big buckets that we have here. And all in all, today, the emerging markets model that runs the portfolio has roughly 80 different signals that drives the investment decision. And it's the aggregation of each individual input that's going to give and drive the investment decision for any given stock on any given day. So the example that we just talked about for TSMC, that particular stock, maybe the retail sentiment score is very positive, but it's being negated by maybe it's been driven too much, so it's too expensive. So valuation is negatively scored, but maybe there are other measures. So across all of these 80 different inputs, the aggregate's going to give me that score, and it's going to ultimately provide the investment decision that leads to the likelihood of this position outperforming the benchmark or underperforming the benchmark. That decision is depicted on page 11, the next page here. So left-hand column is really kind of all the information inputs that feeds into that particular stock. And the middle panel is the assessment of the aggregate score, that alpha forecast, the top line, is being considered alongside the transaction costs. So how expensive it is to trade based on this liquidity, as well as the risk that's contributing into the overall portfolio relative to my existing position. That delta, which is the pink bar in the very bottom of the middle panel here, would be the amount we will be trading. And then the process is repeated across 3,000 emerging market stocks in the universe every single day. That's going to give me the ultimate spread of positioning relative to the MSCI Emerging Market Index. So that spread you can see is on the right-hand column here on that chart. So that's kind of the overall setup, and I'm gonna head into the overall performance summary for emerging markets for 2021 and with a specific view around Q4. And so you can see on page 13, overall emerging markets had a negative quarter, which led to overall a negative year for 2021. Specifically, emerging markets declined by 1.3% in the Q4 and 2.5% for 2021. That spread relative to developed markets is actually, not pretty big. It's like 22, 23% for the 2021 calendar year. And if I think about kind of the cross section of all the effects that's driving the equity spread between the 2 regions or across all the different countries, both developed markets and emerging markets were facing, rising rate environment, signaling of the Fed for decreasing quantitative easing policies, as well as, generally different variants of COVID, Delta and Omicron. Those definitely had impact, so those were shared. But the main difference, as I kind of alluded to earlier, is China's increasingly tightening policies across different sectors and different basket of stocks. This really started with initially in the education tech sector in June, that cascaded over to a number of e-commerce, gaming, internet stocks, and then finally in the fourth quarter around real estate and broadly in these US listed Chinese companies called ADRs. And so these are the principal component of what drove the wedge between the world equity markets, developed markets, as well as compared to the emerging markets. And you can kind of see that on the bottom right-hand side on page 13 here, in terms of what has transpired. Maybe we just quickly look at Q4, which is the red vertical bars here. You see a little bit kind of reversal effect. If I think about compared to what had happened in earlier quarters, you had a resurgence of pro-cyclical sectors, energy, material, had very, very strong, a little bit of discretionary rebound in the third quarter and second quarter in the emerging market space, but fourth quarter was a reversal again. I would characterize overall, which if you look at 2021, which is the yellow bars here, it was a year of a multi-reversal effect. What that meant is what had worked very strongly in 2020 did not work as well in 2021. So if I look at the healthcare, real estate, consumer discretionary, these were the leaders alongside information technology in the year 2020. We basically had a bit of that reversal effect in the 2021 calendar year. Now, from a country perspective, on the bottom left-hand side here, now the red bar again is the fourth quarter spread of return. I'm ranking it based on fourth quarter effects. And then the year-to-date 2021 return is based on the yellow dots. I would say kind of overall, it's also a little bit that reversal effect taking place where we saw, China had, one of the more negative returns for the quarter, and certainly one of the leading negative driver for the year for emerging markets, alongside other, I would say, country-specific events. So, for example, Turkey continued to be one of the worst performing emerging markets over the quarter as well as over the year. International investors broadly had lost a lot of confidence in that market, so have been a net outflow situation. Brazil, due to rate hikes to counter inflation, also will posted pretty weak growth over the quarter and over the year. I would say, not a lot of dispersion between regions for within emerging markets. So look at emerging markets in Asia, emerging markets in Latin America, emerging markets in EMEA. They tend to be pretty weak, but there are intra-region kind of disparity that had taken place, which is really a little bit more political policy driven.
Henry, a couple questions on China. One, what percent of the portfolio is currently invested in China?
Mm-hmm. The portfolio, yeah. You want to ask for a second question and answer?
Well, then the
together?
second question is, to what have there been considerations in the industry about how long China would stay in, continue to be classified as an emerging market?
Okay. Yep. So the first question, China, which includes the onshore China piece and offshore China piece that are listed in Hong Kong and the US, all in all, they represent 35% of the emerging market index. So that's kind of the market exposure. It represents 35%. Our strategy tends to look and feel very similarly to what the benchmark in the market is indicating. So our exposure to emerging markets on average is about 32% over the year. So we were slightly underweight. So we held a negative view, especially towards offshore China for the year, but it's still about 32% of the overall market value of the portfolio. On the second question around classification towards developed market, in the interim, it seems extremely unlikely that it would ever be, I would say, reclassified to developed markets. Is based on a number of metrics, it's still as advanced as it could be based on the population per capita measures is still kind of very emerging market status.
Okay.
Henry?
Jim, maybe I can just jump in on that, Jim, in terms of clients allocating to emerging markets and China in particular. We do see, or at least I would say pre-COVID, we certainly saw clients evaluate the possibility of having standalone China exposure. I think that given the policy regulations that came down last year, a lot of geopolitical uncertainty, those conversations have really taken a back seat. The emerging markets weight has grown significantly, the allocation of China in the EM index has grown significantly. I think at some point there's got to be either an index for China or some kind of middle ground for US investors, because there are a lot of emerging markets investors and funds out there that do not have a 30% weight to China. And for years and years, it absolutely destroyed their performance. And it had nothing to do with their philosophy or process. It was really just, did they allocate to China? So it's an ongoing conversation for sure with plan sponsors throughout the US.
Thanks. Yeah, appreciate it.
I have a question.
Go ahead.
Is there a maximum or minimum amount that you would be over or underweight a significant country or even industry or specific country weight? Because if you look at the top 10 emerging market names in the index, that's 25% of the index, and you have 3 names that would represent roughly 15%. And so that's going to, how much you're over or underweight, that is, it takes a lot of little over and underweights in small names to offset what you're going to do there. So do you have a band on that? So you won't get any more than 10% in Taiwan semiconductors and no less than 5%. And what do you do?
Yeah, absolutely. And if you can jump to page 25, that kind of provides a little more context. This strategy is a diversified systematic strategy. So to your point, Richard, we do have a plus minus 5% bound on country relative to the benchmark, and as well as a 5% bound on sector, a 3% bound on industry, which is more specific and more higher breadth. And then on individual stocks within the universe, there is a 3% maximum overweight / underweight relative to the benchmark position. So it forces the portfolio to look and feel a lot like the benchmark.
Okay, thanks.
Mm-hmm. Okay, I'll conscious of time, so I'm gonna jump ahead to page 16 very quickly. And given kind of the conversation around China and US, we do think there is value between or for containing or having Chinese equity exposure in one's portfolio. And just look at kind of top left-hand side, very stark contrast in performance between US and China for 2021, but 2020, 2019, China equities had done extremely well. And really 2021 was a state where it started diverging in terms of policy and actions towards different events. So whether it's peaking COVID in the US or very stringent zero COVID policies, and that's continued to be maintained in China, or looking at inflationary regimes. Inflationary footprint is very minimal in China and continues to maintain at a very soft state in both consumer price index as well as PPI. So that is, by contrast, very different than what the US is facing today and continue to face. And as such, the monetary policy action in the US is, we're certainly expecting decreasing and easing and tightening and rate rising in the US, but in China is the complete opposite. So you do see both fiscal and monetary support that will be continuing to be dovish in China. So how that plays out in terms of the implication to the underlying equities and securities in that market vis-a-vis the rest of the emerging markets, we do think there is value to look at China as a diversifier perspective. Now, obviously from a tightening of different policies, those policies are certainly noteworthy, and we need to manage the risk around those. For example, just shutting down an industry, turning an industry to completely nonprofit overnight. This is education tech in China. Not something we are managing. But aside from that, I would say it's certainly worthy to have those securities within the investment universe. Okay, I would say on page, let's skip page 17. We'll go to page 18. One quick thing, I think what's unique for the emerging markets over the period, it is really kind of around earnings releases. And for a big part of our strategy, the catalyst for gaining returns is when earnings season came through. And so what I'm showing here on the top left-hand side is the x-axis represented different quarters since like ending fourth quarter 2021, and then your y-axis is percentage of emerging market companies that have beat their consensus during the earnings release cycle. And so you can see the last 6 quarters, so these are the green bars, top left-hand side here, have all beaten. There's a net percentage of companies that publish quarterly earnings that have beat the consensus over that period. And and then that if you contrast that to basically pre-COVID, every single quarter, the market tends to underappreciate, or tend to underestimate the earnings effect for the emerging market companies. And kind of the catalyst really is, since COVID, the street or analysts on aggregate, investors on aggregate, have basically given and lowered the bar for the average emerging market companies when it comes to releasing earnings performances. And how does that translate to stock price effect? We tend to see, on average, the market response to beating your already lowered bar. Yeah, you still see a little bit heightened positive effect towards beating your earnings during these events. But the kicker is, if you miss the already lowered bar for expectations, you're going to get a more harsher kind of penalization or stock effect. So I would say it's a pretty interesting kind of phenomenon that has taken place in the emerging market. And over the fourth quarter, which is on the bottom left-hand side here, our portfolio and the portfolio has have been exposed to more beats and misses. So it's net a positive effect for the portfolio in the fourth quarter. And with that, kind of, I'll turn to page 19, which summarizes the performance of the Emerging Market Alpha Tilts Fund. So over the fourth quarter, we did exceed the benchmark performance by close to 40 basis points. However, that still brought the overall 2021 calendar year performance to a negative 1.1% or 1.09% lag from an excess return perspective relative to emerging markets. Since your inception, the cumulative alpha lag was about 76 basis point overall. So certainly not a figure that we're proud of, and to be honest, everything is driven by the third quarter and second quarter weakness in performance for the strategy in 2021. And so that's something kind of, thinking about the geopolitical effects, the unexpected policy effects that take place in China, specifically in select sectors and select basket stocks, those really did hit us pretty hard in that period. But what's notable is we've seen very decent recovery starting from kind of October end of last year that we hope to continue and provide that stable alpha generation in the longer run for 2022 and beyond. And you can see kind of go ahead.
How did the strategy do in the 2013 through 2015 period? Because those were pretty, that's a pretty bleak period for the emerging markets.
2013 to 2015 was pretty strong for us. So 2013, we had 3% outperformance, 14 was another 2.5%, and then 15 was 50 basis points. So this is a strategy that had very strong performance in the longer tenure, and you can kind of see that on page, on the 10-year figure, and even the 5-year figure is really dragged down by, I would say, 2021 was negative And then we had some negative in 2019 as well. But overall, I would say kind of the stable power is there. What, as a quantitative strategy, when is it expected to be a little bit weak is when there are extreme policy events that cannot be modeled, and that is completely unexpected. And so when those take place, for example, Xi Jinping and China suddenly decide to be very strict around, or starting to remove certain sectors or remove the probability margin of particular baskets and industries, that's going to hurt us because it's completely not priced in. Or when 2018 at the start of trade war, geopolitical tension between the U.S. China, that was also a little bit non-expected by markets overall. And that was also when the strategy would undergone a little bit of volatility.
Do you have a figure for January 2022 performance?
Yeah, January 2022 we were about 20 basis point behind the benchmark. It was a little bit of continuation of the kind of the volatility around value growth rotation. But the focus actually for us is really removing the effect about trying to bet with or against value or growth, either one, but really focus on the earnings release that had taken place kind of later on in the month. Those idiosyncratic effects had really helped to drive kind of the relative muted performance that we've seen over the period.
To what extent, I mean, if you look at the whole universe of active managers, you're using more, whatever you want to call it, automation, AI, whatever you want to call it, than most managers. To what extent is the underlying coding that you're using changing every year, and how's that managed? And have you seen dramatic improvements year to year? I mean, how would you characterize that whole process?
Yeah, so I think as a systematic investor and the investment process here really focus on continued evaluation and evaluating the efficacy of all the different inputs that go into the model. And so we do strive for, okay, let's continue to assess if it's failing, if it's no longer predictive, and that predictive decline by nature is really structural. It's not really just cyclical. It's not temporal. We would replace them. We would decrease them. There is on average about 10% of the model that gets improved or replaced every single year. So a big part of the team is we're constantly looking for new technology, new data to make better predictive decisions that go into the model. I would say that's very different to a lot, like maybe I would say maybe half of the systematic managers on the street. They just look at what works and they believe what's worked in the past will continue working in the future. We're not of that view. So we continue to kind of assess and evaluate and make updates. There is kind of, if you flip to later pages, we do show research in flight or research that have been converted into signals that we introduce into the model over the quarter. So that's a frequent thing that we always kind of go over with our investors in a particular quarter, particular period. But yeah, I mean, the whole point is we're not static, and we try to manage towards the underlying current of the environment to ensure that the model is exposed to the best ideas for alpha generation.
Thanks.
I know I'm at time, so
No,
I mean, I'm gonna.
You can continue on if you'd like. I do have two questions. One is like, is there a minimum value of stocks you invest in? You know, is it like $1 billion or whatever? And it also, do you have a percentage limit on a position that you can have in a specific stock?
Yes to both. And so there is 150 million minimum market capitalization that we would screen. So that stock needs to be at least 150 million in market cap value for it to be inside our investable universe. Now, the emerging market index, this particular benchmark, is a large cap benchmark. So we have very, very little small cap exposure. So that the average kind of market cap for that we invest here is like 135 billion dollars. That's kind of the weighted average market cap that we invest in this particular fund, which is kind of similar to what the benchmark weighted average market cap is. So that's kind of your question one. Question two is we do ensure that we don't take, because of, I think Richard asked this question earlier, we do have a 3% bound on each individual stock relative to the benchmark positioning. So we can't load up and own a significant amount of any given stock. That being said, obviously it depends on how big our strategy is, how big the fund is. On the kind of overall strategy level, there is a threshold. We don't own more than 3% shares outstanding for any given stock. And we're nowhere near that given this is a large cap strategy. The underlying stocks are highly liquid. If I want to sell every single one of my stock in this fund today, I'm able to get out of 99% of position with less than 25% of market liquidity participation. So by design, this is a highly liquid strategy.
Thank you.
Given the size of
Mhm.
BlackRock, does BlackRock have more than one emerging market strategy, or is this the strategy for BlackRock for emerging markets?
There are multiple strategies out there. So for example, we run the systematic model here, and there's also sister strategies. Like for example, this one is pure long only, it doesn't short. We have strategy that can allow for partial shorting. So 130-30, we'll call extension strategies using the same model. That's also run by us. But there are also other types of investors. So there are fundamental like individual stock picker strategies. They do exist in the BlackRock family as well. And there are also obviously index investors that just try to replicate the market, and they do not try to beat the benchmark. They just try to give you that exposure to the beta.
And how big is your strategy compared to those strategies? Are you
So we are
dominating?
I guess from an active driven perspective, we are the predominant. So we're the largest active strategy in the firm in BlackRock. Obviously, BlackRock is a huge passive investor.
Yeah.
So we are certainly behind them, but that there's a huge amount of passive assets around the world managed by BlackRock.
Mhm.
If I might ask a question about how much political risk are you associating with Taiwan these days?
This is definitely something that we're monitoring. It is, I would say, on the rank order of emerging market political risk, it's probably third or fourth behind ongoing China specific, just kind of China US, behind Ukraine, Russia, and behind Turkey.
Mhm.
We would say kind of it probably heightened a little bit, and this is something we do, like we monitor and normalize chatter from financial news. We kind of monitor chatter from analysts that publish these type of kind of analysis on the street. It heightened a little bit over the summer in 2021 when we saw kind of a large amount of fighter jets that flew into the Taiwan Airstrait. It's since abated significantly. So we have not seen any material action taken by Xi since then.
Until the Olympics are over.
Yeah, right, exactly. Yeah.
There's also kind of a big event is his re-election term is coming up this November. So, we do see relative stability from that perspective. We also expect the Chinese market to be more benign until kind of, he's not going to risk, revolting the economy and his underlying quote unquote voter base before that November period. So we do see that as a tailwind a little bit to support the market. I know I'm up on time. I know you have a other agenda, but I want to close out on page 20 just to provide that assessment in terms of performance attribution. We did mention the model is driven by fundamental sentiment macro themes. Within fundamentals, we do break them down by value and quality. Quality can be like, how prudent you're managing a company's managing their assets, their balance sheet. It's also a measure of how sustainable are their earnings and business fundamental momentum. Value is obviously based on a bit contrarian, looking at kind of the valuation, various types of valuation in the cross section. So we break them down for you in terms of the quantitative contribution over each given quarter over the past 8 quarters. So this laid out here, and you can see kind of, majority of the weakness really stemmed from the third quarter of this year, a little bit on second quarter as well, where we just saw, every kind of component of the model being very weak in the third quarter as well as the second quarter of this year. But it's just, we're trying to show you here there are ebb and flows in terms of what part of the model is working, what parts not. Hopefully we do see kind of overall everything's positive, or at least there'll be offsetting effects taking place over a given period. In the longer run, certainly this model has shown to be resilient to different changes.
If you want to continue on, that's fine. The only person who will probably complain is Joe, but I can take the heat from him for the meeting to run over. So continue
What
on.
about for 2 of us?
Are you still in Florida?
Just got here.
Oh, well, you got warm weather. You don't have to worry.
It's dark out, so, I got to stay inside now.
Okay.
Continue on.
Okay.
good.
Thank
We're good.
you very much. Yeah. I mean, I would say kind of, on the bottom right-hand side on page 20, this is just to show over the fourth quarter. You can see the alpha contribution, so excess return contribution in the red bar. This is stack range across different sectors, and my average positioning relative to the benchmark in the yellow dots. So you can see the model had tilted towards a pretty heavy overweight in information technology sector in the fourth quarter, underweight consumer discretionary, and those are kind of the top 2 drivers in terms of alpha generation. And same concept on the bottom left-hand side from country perspective. These are top 8 versus bottom 8 country contribution. And you can see here positioning around Russia and the position around Taiwan and the position around India have been most additive. And I would just say notably kind of, we also were net positive in some contribution in China positioning, which is, a pretty strong underweight over the period. I'm going to skip 21 because that's just a different slice of the same attribution picture. Page 22 perhaps just gives you a little sense of this is the overall 2021 calendar year. I'm breaking it down kind of the alpha contribution effects from cumulative perspective. So top left-hand side here, breaking down by factor groups. So how much alpha has been delivered through security selection and how much alpha has been driven by our country timing and industry timing in green and red respectively. And you can see kind of the main laggard really stemmed from kind of a June to August period. We just had very weak stock selection that really stemmed on the back of kind of being round-footed by the education tech announcement in China that really hit us pretty hard. And then that caused a subsequent deleveraging in a lot of Chinese names that hurt some of our positioning in the Chinese securities era. There's also a little bit of effect taking place in the second quarter, specific to the surge in energy stocks, surge in raw materials that went contra to some of our positioning, specifically in Chile and specifically in Russia. Obviously, we've seen a lot of these reversing in terms of the effects in the fourth quarter, but they were still pretty notable in terms of the drag in alpha performance. One thing I would note maybe is just to point on page 24, and then I'll close out with the page afterwards. On page 24, and you can see here, navigating regulatory headwinds, we wanted to point out, top right-hand side is like that news media volume. This is looking at Bloomberg News. So every single news that's been published on the Bloomberg terminal with kind of Chinese tech crackdown, all that we monitor. It definitely had notable increases in, starting the third quarter. We saw that bumping up to kind of 3% of all news published having these terms in them. And looking at bottom right-hand side, the Chinese ADR index, which is the NASDAQ Golden Dragon Index, have seen a 57% decline from the peak of February 2021 this year. So certainly, this is a big risk element that we've seen because it's not just Chinese government being very antagonizing in terms of its own companies being listed in the US and trading there. The US side has also shown a lot of concerns because of lack of transparency, lack of disclosure. So they've also been pushing for Chinese ADRs to be delisted out of the US exchanges. So we've seen kind of the two-pronged pressure addressing a lot of these Chinese ADR companies. And so we've taken risk actions there. Our exposure were well controlled. So you can see on the bottom left-hand side here, the red bars are contribution to alpha over the period, and then the right-hand, the yellow dots are average active weight. So we've maintained a very strong underweight towards Chinese ADRs that contributed to about 30 basis point of excess return over the period. So that's something we continue to maintain to today. We want to ensure that for Chinese companies that cannot be listed in Hong Kong or in China, Shanghai and Shenzhen exchanges, whether it's by kind of regulatory reasons or it's qualification reasons, we ensure that we don't have any exposure because we do see the ADR space to continue to be negatively impacted by that political atmosphere right now. Lastly, on page 27, just looking at model management overall. You can see kind of the risk decomposition. We're taking roughly kind of 2% in active risk. This is kind of a ex ante based on the projected risk level for the strategy. So of that kind of 2% active risk, we're taking about 66 or 64%. So 2/3 of it is stock specific risk we're taking. And then 1/3 of it is the timing of country, industry, and generic styles. So you can see a big part of it is a little bit of country weight, a little bit of industry weight, but majority of our risk is in stock specific here. And in terms of kind of the ideas around fundamental sentiment and macro themes, you can see on bottom left-hand side is kind of roughly 45% around fundamental and sentiment, so equal split between the two, and then about 10% around macro thematics. That's kind of the input we put in today. And the risk of the portfolio, active risk of the portfolio is maintained at kind of a strategic level. No particular increases since we've notched up in the fourth quarter. And then in terms of other decisions that we're doing, we want to ensure kind of the Chinese ADR that we talked about, no overweight there. And then we certainly don't have overweights in exposure in Turkey. What is, I guess, perhaps more topical is Ukraine, Russia. So specific on Russia exposure, we actually favor Russia quite a bit. And you can kind of see that on page 26. Page 26 on the upper panel here, you can see Russia driven by a little bit around what we call a political risk premia, as well as kind of valuation. We do like Russia quite a bit. We do believe the underlying sentiment here is overblown. And so there have been a lot of investor reaction negative to the Ukraine-Russia event that's taken place over the last 4 or 5 weeks. And we see that being oversold. So the model has continued to tilt into Russia. I would say the positioning of our Russia overweight is manifest in a very defensive way. So we are overweight the metals mining industry within Russia, but we're underweight broad financials within Russia, which tends to be where you think about the sanction activities that might take place against Russia, where a lot of the pressure were actually along the financial sector. So we actually came out of it kind of in January. We came out of Russia kind of with 50 basis point outperformance that contributed to the strategy. Okay, that's kind of what I have. I have maybe 1 or 2 research example I can talk about, but I want to be conscious of your time, so let me pause here.
Okay, does anybody have any questions? If not, I want to thank you for your presentation. And
Thank you.
we'll.
Thank you for the continued support.
Excellent. Thank you very much.
Thank you, everybody. Enjoy your evenings.
Thank you.
Thanks,
Thank you.
Brett.
Thank you.
Britt, performance review?
Sure, Frank, happy to bring it up. Before I do so, does anyone have any reaction to BlackRock's presentation? It's obviously a pretty sophisticated platform, to say the least. They do run that strategy for nearly every index in the US as well. So it's a really big platform in BlackRock. Callan certainly is a proponent of them, but as you can see, even in a risk controlled, lower tracking error type strategy, they can still underperform. But I think outlook in general, we still have confidence in them going forward.
Okay.
Yeah, your over and underweights are so critical because it's such a, you know, top, such a concentrated index.
Move on to performance, Frank.
Let's do it.
It looks like Frank, is he frozen?
I'm here. Did you? I thought you were
Okay.
gonna.
It's
I thought you
late
were
taking
gonna
a nap,
start with
that's
the
all.
performance review,
You know,
I'm
I have
starting.
trouble-
Do you want?
I
unless
have
you
trouble
wanted.
telling that too, Brett, whether he's frozen or not. I mean, it's,
I meant
that's why I come
Frank,
to
I meant
Florida, so
nothing
I
by
don't get
that.
frozen.
My 2 years of Zoom meetings catching up with me.
Gonna be almost 50 here, Rich. You're missing it, gonna miss it.
All right. So everyone has the flash report up. We have the December 31st flash report, and on page 3 we show the asset distribution. Everything pretty consistent with past months and quarters. Slight underweight to U.S. equity and international equity, slight overweights to private equity and global equity long short, as well as absolute return and real assets. You will see the withdrawals to raise cash, 6 million out of US equity and 3 million out of TCW Met West. We will come back for cash needs next month as planned. So I will discuss this with Jitsme leading into the next meeting, and we'll come with a recommendation. If we turn ahead to the next page to discuss performance on page 4, U.S. equity, your U.S. equity managers have performed outstanding. You can see first LSV in the fourth quarter alone outperformed by 3%. And you can see their trailing 1-year return up about 9% versus the benchmark. If you recall, this strategy is a very deep value contrarian approach, which was out of favor for a long time. And they have really bounced back as we've seen value rotate into favor. Columbus Circle performance continues to be very strong. You can see fiscal year to date up almost 7% over the benchmark, and really over all the trailing periods, very strong returns. Hopefully you all saw my email about the changes that were announced. I don't think any of the changes, the leadership changes, were necessarily a surprise. Chris Corbett, who was the lead PM on SMID and small, was essentially promoted to leading the CCI platform at principal. One of the other PMs who managed the mid-cap strategy was released. So there is some turnover there. I think we had a call with them last week. I think it provided some help and an understanding into the changes. That being said, the client concentration risk at Columbus Circle remains very high. I know we've discussed this a number of times, and we have another call with them next week just to understand a little bit more about those clients and principals' conviction in really supporting this team going forward. So at the next meeting, we'll come back with more of an opinion from Callan. I think from a team standpoint, this sets the people in place that have been in place since Cliff Fox's retirement. But there are still some serious concerns about the client base and the concentration there.
should we do an evaluation of potential other SMID growth managers and get it? And so we have some alternatives in mind.
Yeah, and we've discussed it internally. I don't think we've reached that point quite yet, which is why we're having another call with them before we would recommend anything like that. But it's certainly a possibility, especially because the Columbus Circle account from Norwalk is a separately managed account. It's not a commingled vehicle. So getting out of the securities or transferring the securities is a much more complicated transition. So, while the client base is concentrated, the key people have been incentivized to stay. They've been promoted. Principal does have a significant investment in the portfolios, which helps give us a little bit of solidarity in terms of supporting the platform. But at the same time, there are concerns there. So Rich, next month, we will come back to you on that and provide more of an opinion.
Thanks.
Moving on to international equity, you can see Artisan underperformed for the fiscal year and really has underperformed the EFA growth index over the period shown here. If you recall, this is a GARPy strategy, so growth at a reasonable price. So there's a valuation and a quality component, which certainly has not been in favor over the last 3 to 5 years. They'll be coming in to present next month. While I think from Callan's point of view, their performance is explainable, they've underperformed a significant amount of time here, and I think we need to assess whether they're a good fit or not moving forward. Silchester has underperformed for the fiscal year, but longer term continues to be very good. I would note that in January, we saw Silchester outperform by about 5% over the EFA index, just in the month alone. So strong performance there in January. We heard from Blackrock. I would note that Blackrock is a performance fee. I think it's a 35 basis point management fee and then a performance fee on top of that. So while their underperformance is not something anyone wants to see, Norwalk did negotiate a good fee schedule with them to lighten the load a little bit on the times like these. Global equity long short managers have had a tough time fiscal year to date. If you recall, when we had Blackstone in about a year ago, both of these managers in the short squeeze, when a bunch of those unprofitable stocks hit the headlines at the beginning of last year, I think a number of them were caught in that, and that performance is still coming through in these numbers. And then finally, on the last page here, your fixed income managers, muted returns, as Frank always likes to remind us, and but they continue to outperform their benchmark long-term. And I would highlight that UBS, strong performance fiscal year to date, and PIMCO has had strong performance, certainly over the last year. They had a great fourth quarter. I think the only thing that's really hurt their performance of late is emerging markets exposure within the fund, but they continue to be a very good manager. And then you can see the total fund performance on an absolute basis for the trailing year, about 12.5%, and really strong performance over the 3, 5, and 7-year periods. Any questions
on performance?
No.
Nope.
I have a related question. Are we taking another 25 basis point or 12.5 basis point cut to the discount rate? Or
I believe we're going to try to in June, yes,
okay.
till we get down to 6.5.
And I
Okay.
believe the actuary
ultimately
is set to present in April. Chitsame, can you confirm that? I think they were supposed to be March, but we pushed them back to have Artisan in.
Yeah, we're actually looking at the pension actuarial report for July 1st, 2021 right now. So they're in draft mode. So they should be completed before the meeting in April.
Okay.
Chitsme, while you're there, do you have an idea of how much you will need next month in cash?
Right now, we have about 10 million and we still have February and March to go. So by the end of March, we'll probably have around 4.5 million of cash available.
Which would mean you would need, say, 6 million?
Yeah, around 6 million to get us through the next quarter.
Perfect. Excellent, thank you.
You're welcome.
Anything else? If not, we're going to go on to a discussion of ESG. This is something that I was contacted by two members of the city council in regards to possibly some divestiture of, or discussion or an evaluation of what we do. I did speak to the mayor shortly also. So what I would like to do is read from our investment policy statement. And on page 6, it is social investment policy. And it reads as follows. In observing its duties and responsibilities as trustees for the pension fund, the board is also aware of and sensitive to other social matters as may come before the board with regard to the investment of the funds. The board will be guided by its ultimate responsibilities to provide benefits to the participants and beneficiaries of the fund. If you recall, this wording was altered about 4 years ago for a situation like this. So I've had discussions primarily with Dominique Johnson, who was very nice. She's on the city council. And so I think that we should go over this, and Brett could maybe now talk about what Callan feels about this and possible education for us. But I think we also have to remember that our number one responsibility is our fiduciary responsibility as members of the board. And as fiduciaries, which I read over again, is to provide for the proper investment of pension funds as best we can. So with that, I would turn it over to Brett. Thank you.
Thanks, Frank. So in terms of ESG and divestment, I think from Callan's perspective, divestment would be an absolute last resort. There are many ways to either implement ESG, whether that's in your IPS or within a portfolio or a fund. But ultimately, the best way that we feel to start is to provide education for the board on what ESG means. It means different things to different people. What are the ways that plan sponsors can implement their views if they have them? And really try to work with the board through education to develop a consensus view. And that consensus view might be we should enhance the IPS to cover environmentally friendly issues or something else. That could be, the DC plan and discussing an ESG option in the DC plan. That could be, enhancing the ESG data and really questions that we're asking Norwalk's existing fund managers and the way we look at new fund managers. So there's really a huge breadth of how you could discuss this, implement, and really move forward. And really as a starting point, we would want to have education with the board to try and understand what the board's views are. I think, we've had enough discussions over the years with what's in the IPS. And that came to a consensus with the group on how to craft that language appropriately. But given kind of Frank's discussions, it seems like a good starting point with one, just next meeting or meeting after, have a conversation about the ESG universe, what clients are doing, and really try to gain a consensus and an understanding of how the board wants to move forward, and then we can help support you in doing so.
Brett, one thing I'd be interested in is, how good are the metrics around ESG for individual companies or managers? Because I just don't know how you measure some of this stuff.
Yep, and I think every data service that provides a rating for a fund or a company has a different way of doing it. And that is certainly an issue that we encounter, in that you might use MSCI's ESG ratings and, say Silchester gets a great rating, and then you might use another analytics company and their ESG rating might be terrible. In terms of performance and seeing the conclusion that ESG metrics or processes and concerns that are built into funds, do they contribute to outperformance or underperformance? I think that is, a debatable question on both ends. And it's more of, does this board, since you are the ultimate fiduciaries of this fund, does this board have a view that, coal companies are never going to contribute to returns, and they're going to hinder returns, and it's better to be a good citizen and not support coal companies than it is to include them in your investment funds?
I think that corporate America gets it. So we invest in corporate America through different fund managers or mutual funds. I think they all get it from what I can see. And even coal companies might put diversity on their boards and might do different things and put clean coal converters on their smokestacks or whatever you want to call it. From my perspective, I think they get it. Corporate America gets it. And I don't know if we want to start saying you can't buy this, you can't buy that, you can't, I don't know if that's the right answer. If you look at ExxonMobil and you look at their ESG score, being a fossil fuel company, they rate, if you look at it, very high on ESG. If you look at one of their scores through Standard & Poor's, for example, I don't know how much time we want to put into, we can discuss it, we can educate ourselves about it. But I think corporate America gets it. I mean, from my perspective, I mean, are we going to micromanage what the managers can buy and that kind of stuff? Is that what we want to get into?
I would add, Joe, that predominantly the vehicles in the pension and OPEB plans are commingled vehicles where Norwalk, even if you wanted to divest, you could not.
I mean, it doesn't make any sense. But they get it. We all get it. We all get it. But if we have to make a statement as a group, and get our arms around it, we can do that. We can do that. I think, to how much time and effort we want to put into it, that's up to the other members of the board. But I think corporate America, from my perspective, they get it.
I can give you a little historical perspective on this, because the issue has come up repeatedly in the past, probably before any of you were on the board. And every time it came up, the fear was that the board would adopt as a policy investing for any reason other than maximum return. And as fiduciaries, I think that's our responsibility. We have to look for absolute return. Now, somebody can tell me that investing in a coal company will give us $4 and investing in a clean company will give us $4, I'm going to opt for the clean company. I'm just not sure that's possible. But what I really fear is adopting an official policy that says we're not maximizing the return. Because if I'm a pensioner and I see that this is what the board is doing and they're jeopardizing my future pension, I'm going to consider taking action against the board, and I don't want to put us in that position. And that was a decision reached each time this came up in the past.
You know,
We get it. We get it. We get it. They get it. Everybody gets it.
one of the things I did spend quite a bit of time on this, and in my discussions with those on the city council, two on the city council, I feel that first of all, as a fiduciary, I agree exactly with what Charlie just said. But also you get into a situation where, for example, Silchester has a small portion of funds in Israel. Now, there's some places that want to divest from investing in Israel. People are opposed, if you don't like the oil companies, well, they're in the S&P 500. So are we going to no longer invest in index funds that have that?
How about
And
Russia? How about Russia with emerging markets? I mean, we can go on and on and on and on.
Right. China. I mean, I even joked with them and I said, so many people have said save the whales, and yet Japan doesn't allow, or Japan rather allows whale hunting. So maybe we should invest in Japan. I mean, I'm joking, but the reality is it would be very difficult, I think, to do. And especially as Brett pointed out, we're commingled funds. So we would have to separate ourselves out, and it might be complicated. And I do think that one of the things is that Callan did produce the role of fiduciary on February 13th, 2019. I don't know if you could see that. And perhaps if Brett could send an email with a copy of this to everybody so that people could read it over and understand exactly what our responsibilities are. I think that would also be really important. I mean, I do believe, we should, as Charlie said, if there's a company that is polluting, making $4, and a company that's not polluting and making $4, and they're in the same basically field, then yes, we should go to the one that is the cleaner company. But we have to be aware that our primary purpose is to provide for the retirees of the city of Norwalk. So
Yeah.
I think that, but again, it would be good, perhaps there might, and ironically, I did look up that now the numbers might have changed slightly from when I looked it up, but the solar and wind index was down 38% or so over the last 12 months, and the fossil fuel index was up 40 something percent. And I think that it's good that some of those indexes did have the fossil fuel stocks in them. But
and Frank, I think the other thing is are the city council members that you're hearing from, do they have money in the pension funds, or are they just bystanders?
well, I don't know that matters. I think
it does matter.
well,
If it's not their money.
Wait, time
Yeah.
out. You asked a question, so I think it'd be nice if you let me answer it.
Go ahead.
Regardless of whether they have money in it or not, what they are is they represent.
Taxpayers. They're taxpayers.
They represent a constituency, and they have said to me that their constituents have questioned it. And those constituents could be city workers who do have money in the fund, or they could be taxpayers who could be concerned about it. So there's reasonable for them to contact, I believe it's reasonable for them to contact us, and I believe it's reasonable for us to discuss it. And then to conclude at the end of that, whether we make any changes accordingly.
Yeah, I'm fine with that. I don't have any problem discussing it. I just think if if we're going to do something different with current employees that are in the pension fund or retirees in the pension fund, you know, it's something we should be very careful about, listening to other people that aren't invested.
You know,
One of
an alternative is to invest in an ESG fund. I mean, there are a number of actively managed funds. And so we do we could do an allocation to that. I mean, there are alternatives.
Richard, all they've done based on what I see is they put ESG after the name of the manager. We are now an ESG manager. Okay, because what I'm saying is corporate America, if you look at the ESG rankings, pretty soon they're all gonna have ESG after them. All the managers are. Look, if you want Silchester, they'll come out with a Silchester ESG fund. It'll be exactly what you have. Okay, they're not going to change.
I do think that Joe is right on that, in that I read that there are even some ESG funds that have oil stocks in them.
Absolutely. Look at ExxonMobil.
Right.
Look at how they rank.
So,
Well, you know, that's fine, but what I'm saying is that is one we'd select, right? I mean, we can be we try to get as much information we can and make an informed decision. And an alternative to this is are there viable ESG funds that would be an appropriate vehicle for investment? Normal money. No. What we do is that we ask questions, we get information, and make a decision. And so it may be true, Joe, that 95 or all the funds or ESG funds are made up. But I think part of our process and part of our strength as a board is that we look at information and make an informed decision. And I don't
Let's start with the international managers, and let's start with Silchester. Let's see if we can find an ESG manager that competes with Silchester.
well, wait, let's not, one suggestion I do have is this, that the defined, obviously we have both defined benefit and defined contribution. Within the defined contribution, an individual, if we found a fund or two funds that were reasonable, that were environmentally aware, those funds could be perhaps added into the selection of funds that people could put in, because really right now, we're probably nearing a tipping point. Chitsame could probably help me with this, but at least for the city employees, not including police and fire, we could be very close, if not a majority of people are involved with the defined contribution and not the defined benefit that are active employees. Would you have any idea, Chitsame, as to how close that would be?
Well, I mean, the pension plan closed to new hire, I believe, in 2012. So any new hire subsequent to that are going to be in the defined contribution plan, except for police and fire, they're still in the defined benefit plan.
But with that number, do we know exactly or near a number, how many are now in the defined contribution?
I don't have it in front of me, but I could definitely get that to the board.
That would be wonderful, because at some point, if it isn't half now, 5 years from now, it'll probably be more than half of the people who are actively employed in the city will be in defined contribution. And so we could allow them to select a fund if we found a fund or two funds they could select those funds and they could self-direct. And also those funds would be available to people who have others aside from that, who have like, those supplemental plans, the 457s, et cetera.
ESG is a very broad definition. It's just not environment. It's diversity, it's equity. It's a very big, it's not just fossil fuel. It's how many board members are minorities on the board.
Wait a minute, wait, Joe, what you're saying is that we really need more education on this area. And I don't have a problem with that. I mean,
Let's educate
more
ourselves.
information on some of these funds and what constitutes their investments and how they're measured, who does the measuring, all of that kind of information, because I really don't know.
Yeah, and I think Brett was going to come back with that, so maybe we're jumping the gun
And
here a
I'd
little bit.
rather than
Okay.
go into more detail, I'd rather get that information first.
Let's get educated.
Yeah, and I think from a process standpoint, yes, you can technically probably choose to just add an option to a DC plan that covers ESG, but to Joe's point, ESG means 1,000 different things. There are funds that concentrate strictly on environmental awareness. There are funds that concentrate on governance and social issues, and they really run the gamut. So until the board understands if there is an issue or a certain sticking point that you have consensus on and really is how you want to show that consensus, then we can go down that avenue. But, at least in my experience, certainly with DC plans, we have had a few clients at ESG options. There are a lot of options out there, mainly in equity, global equity, US equity. They're active and passive options. So it really runs the gamut of if you have a view and you have a consensus view on after you receive education and you understand the universe of funds out there and the types of funds out there, then it becomes an implementation issue. And you have to have that discussion. And we would want to bring back the investment structure analysis that really evaluates the plan lineup, what are participants doing, and where is a suitable area to add a potential option. So from a process standpoint, we feel it starts with education. And if you want us to kind of broadly discuss the ESG universe, we're happy to do it. And we can certainly bring in some of the metrics and some of the confusion to Jim's point earlier on, what's rated high versus not high. And, to Joe's point, a lot of these ratings agencies, Exxon has I believe a zero carbon 2050 goal or 50-year goal, and that's why they're ranked so high in ESG. It has nothing to do with their current pollution. It has to do with that they addressing it and moving forward. So it's
they all are. Corporate America gets it.
Right, and governance has always been a part of all of these funds, and it will continue to be. So I think from a starting point, broad education for the board to try and have a constructive discussion to see if there is a consensus view, and then we can take the next steps to see, how can you implement that view, whether it's in the DC plan or in the pension plan.
Okay.
Perhaps next meeting we have Artisan coming in. I think we might have, because we had OPEB in December, we would probably be having the OPEB meeting in March, every
Correct.
3 months. So, but that's usually a very short meeting. So if you'd want to just, even if you had, if you had any information that you felt it would be helpful for us to review before the meeting, if we had a meeting and then a brief discussion. And also, again, if you could get the, as I said, what the fiduciary, and send that out to everybody, that would be helpful too, because our primary responsibility is investing the funds as best we know how. And that's what we've done over the years, and we've been moderately successful doing that. So, but it was brought up by, as I said, by some on the board, and they said their constituents were concerned, and I do believe that, we are here, we serve at the pleasure of the city council nominated by the recommended by the mayor, and I think that if people in the city are concerned or want to at least have the board have a discussion on it, I think that's a valid point of view on their part.
Mhm.
So,
Okay.
Yeah,
No,
Frank,
good.
why don't, before the next meeting, I'll distribute some ESG research, and if the board can review it beforehand, it should be relatively straightforward in terms of the layout and everything else, and then we can have a discussion at the March meeting.
excellent.
Sounds good.
Any other comments? Any other business to discuss? Anybody want to say motion for adjournment?
Frank, I have a question first.
Okay, go ahead. Sure.
What is on the wall behind you? Is that a mural or what is that?
Oh, that's it's actually an oil painting by
Oh, it's
a
big.
Dutch artist that, and
Okay.
it's a view from atop of the Eiffel Tower looking
Ah,
down.
okay.
It's a shadow of the Eiffel Tower with like some
Interesting.
people.
Yeah, I like it.
Thank you.
Well, I had a question about the clock behind Britt that says 5 minutes to 2.
I fake conference
Oh
room.
my God,
Charlie.
it's getting old, guys.
Jeez. Okay.
It's right twice a day.
All right, I'll make a
So-
motion to adjourn.
Second.
So, all in favor?
Aye.
Opposed? No. I want to thank everybody very much.
See you
And next
later.
week,
Frank,
whatever-
thank you. Good night, everybody.
Good
Good
night.
night.
And hopefully,
Good month.
people, hopefully we'll meet in person. So next meeting will be the only meeting where we all have like white sheets behind us. So no.
All righty.
All right.
Have a
All right. Good
night.
night, everybody.